So you're getting into investing. That's awesome. But you need to know you're about to step right into the middle of a huge debate. It's this massive showdown that splits the whole financial world right down the middle, active versus passive investing. And honestly, it's probably the first big decision you're going to have to make.
And trust me, this isn't just some boring technical choice. We're talking about two camps that are so dug in, they're almost like, well, religious sects. Seriously, each side is completely convinced their way is the only right way to grow your money. So the big question is, how do you know which camp to join?
And that's exactly what we're going to figure out right now. My goal here is that by the time we're done, you'll have a really solid idea of which of these philosophies clicks with you, with your goals, your personality, and yeah, how much risk you're willing to take on.
Okay, so let's get right into it. What do these two sides actually believe? Well, on one side, you've got the passive investors. Their philosophy, just buy the entire market. Simple. And on the other side, the active investors. They're the ones who believe they can outsmart everyone else, pick the winning stocks, and actually beat the market. All right, let's start with passive investing. I love this analogy for it, the fruit basket approach. Think about it. Instead of spending hours trying to find the single most perfect, delicious apple in the whole store, you just buy the pre-made fruit basket. You get a little bit of everything. In the investment world, that basket is an index fund or an ETF, something that tracks, say, the S&P 500. With just one click, you own a tiny slice of the 500 biggest companies in the US. The goal here isn't to beat the market. Nope. The goal is to be the market. Now let's flip that completely on its head and look at the sniper approach. That's active investing. This is the total opposite. Here, you or your fund manager are putting in the work. You're doing the research, digging into company reports, and trying to line up the perfect shot to pick out that one amazing apple, or maybe a few, that you think will blow everything else out of the water. The goal is way more ambitious here. It's all about beating the market average and hopefully getting much higher returns. Okay, the philosophies are on the table. Let's start the showdown. And first up, we're going to look at the case for passive investing. And believe me, it is a powerful, data-driven argument. I mean, there's a reason why legends like Warren Buffett and even Nobel Prize winners are huge fans of this strategy. So what's the big deal?
It really comes down to this one staggering number, 90%. Let that sink in. Over a 15-year stretch, 90% of professional, highly paid, full-time active fund managers fail to beat a simple market index. So, why? Why do they fail? Well, it's usually two things. First, those high fees they charge just eat away at any extra returns. And second, it's just really, really hard to consistently be smarter than millions of other smart people who are all trying to do the exact same thing.
Yeah, those fees are a killer. And that's where passive investing really shines. It's got these huge advantages just built right in. For starters, the costs are incredibly low. You might pay like 0.10% for a passive fund versus 1.15%, or even more for an active one. That's a huge difference over time. Plus, it's so simple. It's the definition of a set-it-and-forget-it strategy. You also get instant diversification, which is just a fancy way of saying you're not putting all your eggs in one basket. And since you're not buying and selling all the time, it's usually way better for your tax bill. It's a pretty compelling package.
Okay, so at this point, you're probably thinking, case closed, passive is the way to go, right? But not so fast. The active camp has a really strong counterpunch. They say, sure, passive is great when the sun is shining and the market's going up. But what happens when a storm hits?
And this is where things get really, really interesting. See, when you buy a passive index fund, you're forced to own everything in that index, the good companies, the bad ones, and the really ugly ones. You have zero flexibility. You can't just sell off the riskiest stuff when the economy starts to look a little shaky.
But an active manager, that's their whole sales pitch. They can make defensive moves. They can look at the market and say, this stock looks way too expensive, let's sell it. Or they can shift your money into safer areas or even just hold cash to protect you when things get rough. They can try to navigate the storm, while the passive fund has no choice but to go down with the ship.
And there's some pretty compelling data to back this up. Just look at the dot-com crash back in the early 2000s. During that meltdown, a simple S&P 500 index fund was in the bottom half of all active funds 100% of the time. Think about that. A good active manager could have potentially saved your portfolio from the absolute worst of that crash.
And it wasn't a one-off thing. We saw almost the exact same story play out during the 2008 financial crisis. Again, the passive S&P 500 index was stuck in the bottom half of its active competitors over 93% of the time. So what does that tell you? It suggests that when things get really scary, when investors need protection the most,
That's when a good active manager might actually earn their fees.
Okay, enough with the charts and the abstract ideas. Let's make this real. Let's follow the stories of two different investors. We'll call them Mart and Tina and see how these two very different strategies actually played out for them, wallets and nerves in the real world.
So picture this. It's 2021. The market is red hot. Tina decides to start investing, and she goes the passive route, just buying an S&P 500 ETF. Simple. Mart, on the other hand, is an active investor. He gets caught up in the hype and buys a bunch of those popular innovation stocks. Then, 2022 happens. The market crashes. Tina's portfolio drops about 20%, which stings, but she just keeps on buying, sticking to the plan. But Mart? His hand-picked stocks absolutely crater, falling 80, even 90%. He is unbelievably stressed out. Fast forward to 2026. Tina's portfolio is sitting at a brand new all-time high. Mart? Well, he's still deep in the red, just hoping to break even. It's a perfect example. With stock picking, timing is everything. But with passive ETFs, time itself can be your best friend, even for giving bad timing.
Yeah, Mart's story is a tough one to hear, right? It's the kind of thing that gives investors nightmares. And it makes you wonder, is there a way to avoid that kind of gut-wrenching stress without just giving up on the idea of picking winners entirely? What if this whole active versus passive thing isn't an either-or choice?
Well, there is a very popular middle ground. It's a strategy called core and satellites. And the whole idea is to get the best of both worlds. It's a really smart way to get that solid, stable foundation, but also have a little fun trying to get some extra growth.
So here's how it works, and it's pretty simple. The core of your portfolio, we're talking the huge majority, like 80 or 90%, is invested in those boring, low-cost, passive ETFs. That's your bedrock. That ensures you get the market's return. But then you take a small chunk of your money, your satellites, and that's where you get to play. You can use that 10 or 20% to pick individual stocks you think are going to be huge, or maybe invest in a specific trend like AI or clean energy. It lets you scratch that stock-picking itch without betting the entire farm on it.
Okay, so we've looked at the different beliefs, we've looked at the data, and we've even looked at a way to combine them. So now let's bring it all back to the most important person here, you. Because at the end of the day, the best strategy isn't some perfect theory. It's the one you can actually stick with when things get tough.
So you got to be honest with yourself and ask 3 questions. First, how much time are you really willing to put into this? Because active investing isn't just an investment. It's a part-time job. Second, how's your stomach for risk? Seriously, can you sleep at night if a stock you personally picked drops 50%? And third, what's your goal here? Are you aiming for that slow, steady, long-term growth? Or are you chasing the excitement of trying to hit a home run?
When you boil it all down, the choice between active and passive really comes down to one simple question. Is your goal to match the market or to try and beat it? One is a proven path for long-term growth. The other is a high-stakes game that requires skill, time, and a little bit of luck. There is no single right answer for everyone. There's only the answer that's right for you.